Friends, in this video for ithought Advisor, I am going to talk to you on the topic factoring inflation into your investing. We all know that rising inflation is certainly going to impact valuations of companies. Interest rates tend to go up, liquidity in the overall system tends to go down. Naturally, the availability of capital for investing will be constrained. It will go down. When it goes down, valuations tend to gradually come down. Of late, we are seeing valuations come down even faster than we would expect or be comfortable with. The reason is that valuations had gone into a zone of excess from which it had to come back into reality. And that is why we are seeing companies lose valuations so fast in the recent weeks. The coming months are going to be extremely interesting because the battle against inflation will go into its next phase. We are going to see an increase in the efforts made by central banks and governments to contain inflation. We will see rates go up, we will see liquidity go down further, we are going to see loans becoming scarce, we are going to see inventories come into the market. The holding power of inventory in the hands of producers will go down. Everybody will want to create more liquidity from what they have. Naturally, this will exert a downward pressure on prices. But one must factor in that when all this happens, growth will be a temporary casualty. So, until inflation is completely contained, growth will be soft, and the return to higher growth will happen only when we have put inflation behind us. The threat has to be contained, and we must be sure that it will not once again rear its ugly head. So, during this phase, an investor must be very measured, very gradual, and invest in very specific areas where he finds the valuations in his favor. So, just simply buying investments based on how much they are down from their recent highs is not going to help. You need to align every investment to its future earnings. You need to recalibrate, readjust the future earnings to the current levels of inflation. You also need to prepare your earnings estimates for a post-inflationary phase. That is, when inflation is contained, these earnings may again go up, and you need to also factor that in some businesses. But that must be done when you are sure that inflation has been effectively contained in the raw materials which impact that specific industry. So it's going to be a very stock specific, industry specific, team specific, and commodity specific time, and your evaluations must be sharp. You need to constantly review what judgments you make, and based on your reviews, you must increase your conviction in some parts of the market where you're seeing irreversible relief from inflation. So it's going to be a very exciting phase. It's not a phase to sit out. It's not a phase to be very scared about, because after a phase of inflation, we will see a phase of better growth, and you will see more liquidity coming to the markets once fears recede. While the fears are high, you could possibly be one of those investors who choose to be greedy to invest in equities, and apply your greed progressively and sensibly during that phase of high inflation. Thank you for watching this video.